Hello everyone. In this recording we are going to talk about the equity section on the balance sheet. And specifically we're going to be talking about corporations. So first of all, what is a corporation? It's a legal entity. I like to tell students it's kind of like a human being in the eyes of the law. And what do I mean by that? It means it can enter into contracts, it can sue, it can be sued. It has to file tax returns. It has to pay taxes. So basically, a lot of the legalities that a human being can get involved with, same as a corporation. So a corporation can acquire, can own, it can dispose of property in its own name, just like a human being. It can incur liabilities. It can enter into contracts. And the sale of ownership shares is called stock. All right, so when we issue stock to stockholders, or once again also shareholders, synonymous terms, they are the owners of the company. Okay, the stockholders of the company, they have limited liability, meaning that the creditors, if anybody comes after the corporation, they can't go beyond the assets of the corporation to satisfy their claims, meaning they can't attach the personal assets of the shareholders. And so that's what we mean by limited liability. Now the owners, the stockholders, they will vote to elect the board of directors. The board of directors, they basically set policy, corporate policies. And in turn, the board of directors hires a CEO and CFO, etc., to run the day-to-day affairs, the day-to-day business of the corporation. So you can see the stockholders are at the top. They are the owners. They elect and they vote on the board of directors. The board of directors will then in turn hire the officers, the CEO, the CFO, etc., who in turn hire the employees to run the day-to-day business. Okay, corporations are subject to tax. And here's a nice little form that talks about advantages and disadvantages of the corporate form. You can see the advantages. They are a separate legal existence. They have a continuous life, meaning even if one of the shareholders dies, the corporation continues. They can raise a lot amount of capital. And so instead of the shareholders individually trying to raise capital, which is an arduous task, you can certainly have the corporation trying to raise capital, and they will probably be more successful with the amount of capital they can raise. There's limited liability, as we talked about. There are also some disadvantages. Owner is separate from management, so you as an owner may have some ideas, but you're really not running the show. There is double taxation, so the corporation will be taxed on their profits, and then when those profits are then distributed to the shareholders in the form of dividends, they are taxed again at the shareholder level. That's called double taxation. And of course, there's a lot of regulatory costs that the corporation may have to pay. Okay, so when we actually record or form a corporation, we have to work with our individual states. So with the state of Florida, we would file an application for an incorporation, and we would do so, and then the corporation is formed. The articles of incorporation. And then after that, we would prepare some bylaws. The bylaws are the rules and the procedures for running the corporation. Okay, so one of the first journal entries of the existence of the corporation was not only to sell stock, but once we sell stock, then we have to pay out some organizational fees, consultants, accountants, lawyers, and basically these organizational fees are really to set up the corporation. So you can see a typical journal entry here. We would debit organizational expenses and credit cash. Now selling stock to the new owners. Let's take a look at this. When we sell stock, we're basically saying that we're issuing the stock. This is a nice little table here, nice little picture, I should say. Now, according to the Articles of Incorporation, there is a maximum limit of shares that are allowed to be sold. That is called the number of shares authorized. And then once we sell them to shareholders, those shares are called issued. So we have authorized, which is the maximum amount we can sell. We have issued shares, which is the number of shares that we do sell to the shareholders. Now, from time to time, the company can buy back those shares. Buying back those shares are called Treasury shares. We'll talk about that in a little bit. But the difference between issued shares and Treasury shares is outstanding shares, which are the shares that the shareholders are still holding. Okay, every stock that we sell has what's known as a par value. A par value is simply just a bookkeeping amount. It has nothing to do with market value. And when we sell the shares are going to be sold and recorded based on the par value. So let me go through, let me see. Okay, let me back up. So selling the shares at par value, let me give you an example. It doesn't look like I have a journal entry here. So here's the example. I sell 100 shares of stock. Each share of stock has a $1 par value. And say I sell the stock for $3 each. So 100 shares I sold times $3 each, I will debit cash, the company will, for $300. But we can only credit common stock for the number of shares issued times par value. In my example, that's $100 shares, times $1 par value. So I've got a debit to cash of 300, but I can only credit common stock for 100. So any amount that you actually receive above and beyond par value, you will credit another account called additional paid-in capital. So just be aware of that, additional paid-in capital. It's also an equity account, and this is where we're going to put the amounts that we received by selling shares to stockholders for above and beyond par value. Okay, there are two types of stock. We have common stock and we have preferred stock. The common stockholders, they can vote on issues in the corporation. Preferred stockholders typically don't vote. But the reason why they're called preferred stock is because they come in line first when it comes to paying out dividends. And we'll talk about dividends in a few moments. Preferred stockholders, like I said, they have first rights or preference to any dividends. And they have a greater chance of receiving dividends. You can see here, nice little picture of the preferred stockholders. Do you see they're at the front of the line to get the dividends? And if their money runs out, if there's no more money available for dividends, the common stockholders are going to suffer at the end of the line. Okay, now let's go through dividends. There are really important dates that you need to remember when we talk about dividends. The first date that's important is called the date of declaration. The board actually has to vote and officially declare a dividend before it can actually be recorded. And so that is something important, the date of declaration. Now, preferred stock comes in two flavors. They could either be cumulative preferred stock or non-cumulative preferred stock. Let's talk about cumulative preferred stock. Now, this word cumulative means that something is going to accumulate over time. So cumulative preferred stock means that the preferred stockholders are guaranteed a cash dividend every single year. Now, if the cash dividend is not actually paid out in cash in a particular year, it will be rolled forward and it will be accumulated into a future year. Those cash dividends that are not paid out in a particular year, even though they are promised, they are considered to be in arrears. You can see that word here, arrears. All right, they're basically behind. in being paid out, but they are going to accumulate until they get paid out. Here's an example. Assume a corporation has issued 1,000 shares of cumulative preferred $4 stock. Now, what does this mean? This means that each preferred share is guaranteed a $4 dividend every single year. It's $50 par value. 4,000 shares of common stock were also issued for $15 par value. The corporation was organized on January 1st of year 1 and paid no dividends in year 1 and year 2. All right, so year 1 went by, no dividends were paid out. Year 2 went by, no dividends were paid out. But remember, these 1,000 preferred shareholders, they are due a $4 dividend every year. What is 1,000 times 4? That's $4,000. So $4,000 in year 1, no dividend. $4,000 in year 2, no dividend. In year 3, the corporation finally paid out $22,000 in dividends. Now remember, the preferred shareholders get in line first. So even though $22,000 were paid out, we have to pay out the $4,000 that were behind from year 1, the $4,000 that was behind in year 2, and the $4,000 for year 3. So out of the $22,000 in dividends, the first $12,000 are going to go to the preferred shareholders to get them all caught up where they need to be. And then the difference would be dividends available to the common shareholders. Okay, so the preferred shareholders will receive $12,000 in dividends, and the common shareholders will receive $10,000. Okay, now one last item I want to talk about when it comes to preferred shareholders versus common shareholders, and that is when we talk about but in preferences. That is, unfortunately, at the end of a business's life, if they need to liquidate and they go out of business, the claims of the creditors are satisfied first. But then after the creditors are satisfied and they're all paid off, if there's any excess, the preferred shareholders get in line first for getting a liquidation, and then the common shareholders last. Okay, issuing stock. All right, so here's an example. A corporation is authorized to issue 10,000 shares of $100 preferred stock and 100,000 shares of $20 par value stock. Those are the authorized shares. Those are the maximum limits. So what does the company actually issue? The company actually issues 5,000 shares of preferred stock, so 5,000, and we're going to issue them at our par value. So 5,000 times $100. We'll credit preferred stock for $500,000. The common stock, we issued how many shares? 50,000 shares. And the par value is 20. 50,000 times 20 is $1 million. So we issued the shares of stock. All right, these are equity accounts. And the company receives cash of $1.5 million. Once again, like I said earlier, and I'll say it again here, if we issued these shares of stock for more than the par value, we'd have another equity account called additional paid-in capital. And that's what these slides are saying. Stock is often issued by a corporation at a price other than its par value. And stock usually is sold for a price that's more than its par. Stock is sold at a premium, or if a stock is sold at a price for less than its par, it's sold at a discount. We will use this account called paid-in capital in excess of par. I've been calling it additional paid-in capital. It means the same thing. Here's the example. Assume that Caldwell Company issues 2,000 shares of $50 par value stock, and we sold it for $55. So 2,000 times 50 is $100,000. That's the amount we will credit to preferred stock. But we sold it for $5 more than the par value. So 5 times 2,000 is $10,000. That is the amount that we are going to record as a credit to the paid-in capital in excess of par. the additional monies above and beyond par value. So we received cash of $110,000 that we will debit. Okay, sometimes stock can be sold in exchange, not for cash, but for other things like a building, land, equipment, and whatever the fair market value is that we are receiving, we will debit. We'll credit the common stock for the number of shares that we issued times par value. Anything above and beyond is going to go to the paid-in capital account. And every once in a while, there'll be no par stock. Basically, the bylaws or the articles of incorporation don't talk about any par value. We're just going to basically use the stock account instead of saying instead of using a paid-in capital account. Here's another way we can do it. In place of the par value, the company can officially state a stated value. All right, so the stated value would take the place of the par value. Here's an example. On January 9th, the corporation issues 10,000 shares of no par common stock at $40 a share. On June 27th, they do the same thing, but they issue them at $36 a share. And the no par common stock is assigned a stated value of 25. So on January 9th, when we issued 10,000 shares, we would say 10,000 times 25. That would be the credit to the common stock account, but we actually sold them for 40 each. 40 times 10,000. We received cash of 400,000, but we're only going to credit common stock for 250. The difference is the paid-in capital in excess of stated value. You do the same thing on June the 27th. Okay. As we said earlier, we can actually issue dividends to the stockholders. The dividend is a reward, really, for having ownership in a company. It's a payout. And so once again, the accounting for dividends is it depends on what type of dividend. We have cash dividends, and we can also issue stock dividends. Let's talk about cash dividends first. A cash dividend is basically a cash distribution to the corporation. Okay, I'm sorry, from the corporation to the stockholders. And so there's really 3 dates that you need to be familiar with when we're talking about dividends. The first date is called the date of declaration. The second date is called the date of record. And the third date is called the date of payment. So what about the accounting entries on these dates? First, the date of declaration. This is the date that the board officially declares or authorizes the payment of the dividend. They will state exactly what the dividend payment is going to be. And on the date of declaration, that is the date that we are going to record the dividends. The second date is the date of record. The date of record is the date the corporation uses to determine who is going to receive the dividend. Because remember, shares of stock are traded all the time. So whoever owns the stock at the close of business on the date of record will be the ones that actually receive the dividend. Okay, and then lastly, of course, the date of payment. And the date of payment is when the actual cash is going to be distributed for the dividends by the corporation. Okay, here is the illustration. October 1st, we have a corporation. They declared the following cash dividends. This is on October 1st. So we're saying preferred stock, $100 par value, 5,000 shares outstanding. They're going to get a $2.50 dividend per share. 2.50 times 5,000, that's 12,500. The common stockholders, they're going to get a 30-cent dividend per share. 30 cents times 100,000 shares, 30,000. So $42,500 worth of dividends were declared. Okay, so on October 1st, we're going to record a journal entry to debit dividends. And remember with dividends, we've talked about it in an earlier chapter, dividends is an equity account. It's actually a reduction of the retained earnings. And we're going to credit a liability called dividends payable. The date of record, there is no accounting journal entry. It's just simply whoever owns the shares on that date are going to get the dividends. And the date of payment is when we actually pay off the liability. We will debit the liability and we will credit the cash account. All right. So those are your typical journal entries for a cash dividend. And as I said earlier, the company can also issue what's known as a stock dividend. And this is especially important for a company that doesn't have a lot of cash. Maybe a newer company that might not have a lot of cash on hand, but they want to reward their shareholders. So instead of giving them cash, they're going to give them extra shares of stock for free. Okay? No more cash payment. And stock dividends, they are normally declared on common stock issued to common stockholders, which is typical. The preferred stockholders, they're usually getting a cash dividend. Here's the illustration. Hendricks Corporation, as of December 15th, they have $40 million, which are basically $2 million shares issued times $20 par in common stock. They have some paid-in capital, and they also have retained earnings. These are their equity accounts. And on December 15th, they've decided to declare a stock dividend of 5%. All right, 5% of $2 million. I'm sorry, 2 million shares. 5% of 2 million shares, that is 100,000. 100,000 shares would be the stock dividend. All right, to be issued on January 10th to stockholders of record on December 31. Now, when we issue a stock dividend less than 20%, which we did here, 5%, we're going to base the stock dividend on what we call market price. And the market price on that date was $31 a share. I'm making a big deal about this because when a stock dividend is greater than 20%, we're not going to use the market price, but we're going to use the par value. That's not the case here. This is market. So if you take $31 times 100,000 shares, the stock dividend has a total worth of $3.1 million. But we're only going to credit common stock, or in this case, we didn't distribute them yet, so we have a temporary holding account called Stock Dividends Distributable. This is only a holding account until we actually physically distribute the shares. This is limited to the number of shares issued, which is 100,000 shares. All right, 100,000 shares times par value. And the par value was 20. All right, I'm sorry, was it 20? Yep, 20. All right, that's where you get the $2 million. 100,000 shares times $20 par value. Anything above and beyond, in this case, it's 1.1 million, is going to go into the paid-in capital in excess of par account. That was on December 15th, the entry to record the dividend. The date of record, there's no accounting journal entry. And lastly, on the date of distribution, we will get rid of that temporary account with a debit, and then we will replace it with the actual common stock account. This is when the actual shares are physically distributed. Okay. So that is important. We have cash dividends and we have stock dividends. Another concept I want you to be familiar with is the concept of stock splits. A stock split is when a company will split the number of shares into multiples, maybe split them in half or split them in 3s or 4s or 5s or more. Okay? Now, why would a company do this? Typically, it's just almost a psychological event where if the company feels that the market price of a stock is getting too high, they will split it. And if they split it, what happens kind of naturally is the market prices go down as well when the stock splits. And what is the notion here? What is the rationale behind it? Well, the more number of shares there are, all right, the lesser the value is going to be. All right, so here's the example. And by the way, there's no journal entry for stock splits, for those of you that are wondering. What are the accounting journal entries? It's really none, but there are a couple of changes that we need to make to our reporting. Here's the example. Assume that Roject Corporation has 10,000 shares of $100 par common stock, and the current market price is $150 per share. The company is a little concerned that this $150 market price is too high. So what the company decides to do is to split its shares 5-for-1. So instead of having 10,000 shares of $100 common, these 10,000 shares were split 5-for-1. So what we're going to do is each shareholder, instead of having 10,000 shares cumulatively, they're going to have 50,000 shares. So the number of shares is going to go up 5-for-1. 10,000 times 5 are 50,000. But you know what else is going to happen? The $100 par value is going to go down. 100 divided by 5 or 20. Okay, so par value down, number of shares issued up. So at the end of the day, before the split, we had 10,000 shares times $100 par value, total of $1 million. After the split, we went 5-for-1. So instead of having 10,000 shares, we have 50,000. And our par value went from 100 to 20. Went down by 5. 100 divided by 5. What are you left with? Still the same $1 million. All right, so there's no accounting journal entry, but we need to be mindful, and the number of shares issued goes up and the par value goes down. All right, and you can see a little explanation here, a little chart that shows you before the stock split and after the stock split. Okay, next section. Sometimes a company will buy back their shares from the shareholders. And when they buy back shares, those buyback shares are called treasury stock. Treasury stock is an equity account, but guess what treasury stock does? It actually reduces overall equity. So, in other words, treasury stock has a debit balance as compared to all of the other equity accounts having a credit balance. And so let me show you an example. Let's assume a company has, on January 1, they have a common stock account, $25 par value, times 20,000 shares authorized and issued. That's $500,000. And they have excess, they have paid in capital in excess over par of $150. So they have total equity of $650,000. So what does the company do? They want to buy back some of their shares. On February 13th, they purchased 1,000 shares back out of the 20,000 shares that the investing public held. The company wants to buy back 1,000 shares at a price of $45 per share. April 29th, out of the 1,000 that they bought, they're going to sell back 600 shares. And they're going to sell them back to the investing public at $60 a share. And then October 4th, they're going to, right after buying 1,000, selling 600, they only have 400 left, and they sell the remaining 400 for $40 per share. What are the journal entries? First, on February 13th, we purchased 1,000 shares for the Treasury at $45 each. 1,000 times 45, that's 45,000. We will debit this account called Treasury stock, credit cash. Once again, Treasury stock is an equity account and it's a debit balance, so it reduces the overall equity balance. April 29th, they sold 600 shares back to the investing public for $60. 600 times 60, that's the amount we debit cash for, $36,000. But we can only credit Treasury stock for the amount it came into the Treasury. It came into the Treasury at $45 a share. It's going to leave the Treasury for $45 a share. So if you take $45 times 600, you will get this $27,000. Any amounts received above and beyond, we will credit paid in capital. And then on October 4th, when we sell the remaining 400 shares at 40, 400 times 40, we will debit cash for $16,000, but we will credit common stock for the number of shares that we sold 400 times the original amount it came into the Treasury. It came into the Treasury at 45, so it's going to come out of the Treasury at 45. So 400 shares times $45 is $18,000. You can see we sold it for less than what it came into the Treasury at. So we will debit paid in capital for Treasury stock if we have it, which we do because we had it from the April 29th. We had a $9,000 balance in the paid in capital Treasury account. Here's what I want to say. If we do not have a paid in capital Treasury account, the debit here would go to retained earnings. So once again, the first thing you do is reduce the paid in capital for Treasury stock. You can eliminate it or you can reduce it down to zero, but it cannot go negative. It cannot go into a debit position. So once you realize this all the way down to zero, you would debit retained earnings. That is not the case here because we have enough to absorb the $2,000. You can see we had a $9,000 credit balance. And last but not least, I wanted to show you the presentation on the balance sheet. So there are two methods. Certainly, the first method is more, basically is more broken out. We have the first section called paid in capital, and that's basically where we have all the monies from the stockholders, the preferred stock balance, and any paid in capital in excess of par value. And that'll give us the total for the preferred shareholders. The common shareholders plus their paid in capital in excess of par. All right, and we'll take those two amounts. All right, and then we have paid in capital from Treasury stock. Add that all in. All right, and then we have our retained earnings. Then we have the grand total, and then we subtract out the Treasury stock. Or you can show it this way. Instead of actually showing the actual stock account and its paid in capital account, you can show the additional paid in capital all in one lump sum if you would like to show it that way as well. Either way works. I think the bottom method is the one that's used most often in the real world. And I wanted to show you here the number of shares issued times par value will always equal the dollar amount. So common stock, we have 50,000 shares authorized, 45,000 shares are issued. All right, if you take the number of shares issued times par value, you are going to get the dollar amount in the account. Okay, and then retained earnings is basically, this is the account that we accumulate all the red balances. You remember the RED, R for revenue, E for expenses, less, R, less the E, less the D for the dividends. They all get closed out to the retained earnings account. And I should have made mention, of course, the retained earnings is also in the equity section, even though we concentrated on stock transactions in this particular chapter. But retained earnings could have a separate retained earnings statement, as we learned earlier in the semester. We'll take retained earnings at the beginning of the year, add the net income, which is the R minus the E, subtract out the D, the dividends, and you get the change in retained earnings for the year. Add that to the beginning retained earnings, and you get the ending retained earnings. All right, so retained earnings statement is also pretty important. And last but not least, sometimes an accountant realizes they made a mistake in a prior period. Instead of going back and fixing the prior period financial statements, they will actually show or report the correction of the prior error, and it's called a prior period adjustment, and it will be reported in the retained earnings statement of the current year. So that's something that is pretty rare, hopefully very rare. All right, and here is a statement of stockholders' equity, which is actually like a retained earnings roll forward statement, but it's for all of the accounts, not only the retained earnings account, but all of the accounts in the equity section: preferred stock, common stock, paid in capital, retained earnings, and the treasury stock. And you will see that the balance at the end of the year for all of the accounts, this bottom row that I'm circling here with my cursor, these are going to agree with what you see on the balance sheet for the particular year.